All right, let's just jump right in. Welcome to The Explainer, where we take massive, complex companies and run them through the absolute ultimate investing stress test. Today, we're basically stepping into the shoes of the greatest investors in history to analyze a true titan of the energy sector, Cheniere Energy. We're going to strip away all the market noise, look at the cold, hard data, and figure out exactly what this infrastructure giant is actually worth. Now, to really get a grip on our contender today, you've got to wrap your head around one absolutely staggering number: 46 million. That's the number of tons of liquefied natural gas, or LNG, that Cheniere produced in 2025 alone. I mean, they export roughly 11% of the entire global LNG supply. So we're not just looking at a run-of-the-mill company here, we're analyzing a literal pillar of global energy security. So here's our roadmap for the analysis. We'll start with the contender snapshot, move through the Buffett lens, the Lynch lens, and the Graham lens, then run the quant models before finally wrapping up with a synthesis and final verdict. Okay, Section 1, the contender, Cheniere Energy snapshot. Right off the bat, to get a current snapshot of where the market values Cheniere, ticker symbol LNG, we actually have to reverse engineer their stock price. Based on a reported 0.9% yield and a declared annual dividend of around $2.11 to $2.22 per share, we can calculate an implied share price hovering right in the mid-230s to mid-240s range. But honestly, the real story is hiding in their earnings reports. If you just take a surface-level glance at their Q1 2026 GAAP earnings, you're going to see a terrifying $3.5 billion net loss. Yikes, right? But you have to dig deeper. Management actually raised their distributable cash flow guidance for the year to roughly $5 billion. As an investor, it's absolutely crucial to separate those non-cash derivative accounting losses, which swing wildly based on global gas prices, from the massive physical cash this business is actually generating day in and day out. Moving on to Section 2, the Buffett lens, seeking moats and owner earnings. So what would the Oracle of Omaha think? Well, Buffett wants four main things: an unbreachable economic moat, a management team that treats shareholders like actual partners, reliable, consistent owner earnings, and of course, manageable debt levels. Basically, he's looking for a financial fortress that can survive literally any macroeconomic storm. And a physical economic moat in this specific industry looks exactly like the massive liquefaction trains at Sabine Pass and Corpus Christi. You definitely can't just build these overnight. They require billions of dollars and years of complex regulatory approvals. But the real moat? Over 95% of their production is already contracted out to global customers through 2030 and beyond. That completely insulates them from short-term commodity price swings. It's a massive advantage. Now, because GAAP earnings are just so noisy with all that derivative accounting we talked about, we have to use distributable cash flow as our proxy for Buffett's owner earnings. And man, the consistency and growth here are just undeniable. Plus, the management team is incredibly shareholder friendly. I mean, they deployed $6 billion in 2025 toward capital allocation and just authorized a massive new $10 billion share buyback program through 2030. So high return on equity, massive buybacks, and a durable moat. Assuming a decent margin of safety, Buffett would likely be a buyer here, even if those debt levels give him a slight pause. All right, Section 3, the Lynch lens, categorizing growth. Peter Lynch famously requires us to categorize a company's story before we even look at the numbers. Is it a slow grower, a stalwart, a fast grower? After that, he looks for an improving balance sheet, maybe a lack of institutional crowding, and a reasonable PEG ratio, which, if you remember, is just the price-to-earnings multiple divided by the growth rate to find its true value. Cheniere is a fascinating hybrid here. At its core, it is a massive, highly reliable stalwart, thanks to its sheer size and all those locked-in contracts. But with Corpus Christi Stage 3 moving forward, plus mid-scale trains 8 and 9 reaching final investment decision, they're actually expanding their liquefaction capacity by over 10%. So that gives this stalwart a sneaky fast grower kicker. With an estimated forward price-to-earnings multiple hovering around 12 based on cash flows and a 10% capacity growth rate, the PEG ratio sits comfortably near 1.2. That makes it highly attractive in Lynch's book. Lynch also absolutely loves an improving balance sheet. And Cheniere passes this test with flying colors. They paid down $652 million of long-term debt in 2025. And by Q1 2026, Moody's actually upgraded their credit ratings to BAS2 and BAS1 with a stable outlook. It's a growing company actively de-risking its balance sheet. So, for Peter Lynch, this growth at a reasonable price dynamic makes it a super compelling buy. Next up, Section 4, The Graham lens, the defensive checklist. Now, Benjamin Graham, he doesn't care about the story at all. He cares about rock-solid, defensive numbers. His checklist demands adequate enterprise size, pristine earning stability with 0 negative years, a long dividend record, and a rigorously strong financial condition. While Cheniere easily passes his test for adequate size, we kind of have to pull out a red marker and just cross out financial condition on Graham's checklist. Graham's strict rules generally demand current assets to be twice current liabilities, along with very low long-term debt. Cheniere, on the other hand, carries a massive $22.8 billion in consolidated debt. To a deep value purist like Graham, that is a glaring, unavoidable red flag. And honestly, here is where the Graham analysis just completely falls apart. Graham's famous intrinsic value formula is the square root of 22.5 times earnings per share times book value per share. Well, because of that derivative accounting loss we mentioned earlier, Cheniere's Q1 2026 EPS dropped to negative $16.65. You literally can't take the square root of a negative number. The formula just breaks. Without consistent GAAP earnings stability, Benjamin Graham wouldn't touch the stock at any price. For the deep value investor, this is a hard sell. Moving on to Section 5, the quant model's discounted cash flows. To build a proper discounted cash flow model, or DCF, we've got to state our assumptions really clearly. Because of the missing standardized data, we're going to use their own guidance as our anchor. We use their $5 billion distributable cash flow guidance midpoint as our base. We project 10% growth for the next 5 years based on those new LNG trains coming online. Then we'll assume a standard 2% terminal growth rate and an 8% weighted average cost of capital, or WACC, which reflects their newly upgraded investment-grade credit status. Now, when we flex that discount rate and the terminal growth rate in a sensitivity analysis, the fair value per share ranges from $200 on the super conservative end all the way up to $320 on the optimistic end. Depending on how strictly you want to discount their future cash, the fair value hovers right around or maybe slightly above their current implied trading price. But if we apply a few other valuation models, the picture actually gets even more interesting. Factoring in their stated goal of greater than 10% annualized dividend increases, a dividend discount model puts fair value right around $250. Alternatively, if we apply a conservative multiple to their massive $7.5 billion adjusted EBITDA guidance, that yields an EV to EBITDA fair value closer to $280. So the quantitative math definitely suggests this stock still has some room to run. Finally, Section 6, Synthesis and Final Verdict. Our final master matrix reveals a pretty fascinating split across all these frameworks. A strict value purist like Benjamin Graham is going to hate the heavy debt load and that messy GAAP earnings volatility. It completely fails his defensive checklist. However, the quant model suggests the stock is fairly valued to slightly undervalued. And both Warren Buffett and Peter Lynch, they would likely love this setup. They'd look right past the accounting noise to see those massive contracted cash flows, the unbreachable physical moat, the growth from new facility expansions, and a management team that is just aggressively buying back stock. So I'm going to leave you with this final thought to chew on. In the high-stakes, incredibly capital-intensive world of global energy infrastructure, is a $22.8 billion debt load a dangerous liability? Or, when it's paired with an asset that is 95% contracted out to global partners for the next decade, is that debt actually the ultimate financial tool for building a guaranteed cash-gushing monopoly? It really all depends on which lens you choose to look through. Keep learning, keep analyzing, and we'll see you in the next explainer.